Hello and welcome to the midweek update at Invest with Rules. My name is Scott Bennett with Mike Olafson. We have a big agenda for you today. We're going to cover rethinking the 60/40, that mix of 60% stock and 40% bonds, and why has that underperformed the past 3 years? We're going to dive into that, talk about our Invest with Rules process. Here we go. Well, first, I mean, obviously, we'll call this kind of like a pie chart type investment where I would say an enormously large amount of the public has some version of this. And how do we get there? And if I rewind back the clock on my career for collectively about 17 years, I worked at a Fidelity Investments, which is a great institution, private, beautifully boring. I'm a huge fan. We hold assets there for our advisory business. But here's kind of the routine that most advisors will go through with you. And not that it's right or wrong, just this is what happens. So number one is determine your objectives. So think time frame. And number two is they identify your risk tolerance. And this is where I have a little bit of problem I'll start with. And what they typically do is they'll say, what's your risk tolerance on a scale of 1 to 10? 1 is low risk. If you have high risk, you're a 10. And here's what I've witnessed throughout my career is most clients are a 10 when the market's doing well, and they're a 1 when the market's doing horrible. And what tends to happen is a human, we have a lot of recency bias. So what tends to happen is at the bottom of a bear market, your scores are really low. So what you're telling the computer algorithm for most advisory practices is keep me at a lower stock exposure. And then when the market's at a near all-time high, you're like your number's way higher. So then you're most exposed at the top and you're least exposed at the bottom. So we obviously don't do that. We follow trends, and in uptrends we get to the left lane of the highway as fast as possible. In severe downtrends, we get to the right-hand lane or off the highway. Mike, I'm going to stop there. So far, maybe you've gone through this personally, but so far, step one and step two, any thoughts or comments?
Yeah, it's basically the old adage that it's the fear and greed. At the bottom, I'm totally fearful. I want to get super conservative or in cash or close to the bonds. And then at the top, I'm super greedy. So it's the classic human nature of trading and investing.
Yeah, and I would say as I occasionally go on like financial Twitter or on Reddit or all these different sites, the second no one wants to say fear or greed, but if you just kind of get the feel of what crypto or Tesla or you start to get this feeling of sentiment and how people feel, and it becomes a little bit stretched. Okay, so then you're going to then define your time horizon again. So what's my goal for the money? Is it retirement? Is it short term? What's my time frame specifically, or when I have to start touching it, or how much I have to pull at a certain point? And then they come to the where are you with the modern portfolio theory, which is totally fair. So how much stocks, how much bonds do you have? And I'll zoom in, and I would say that for most of my career, almost everyone fell in these several buckets. It's either your 70 stock, 30 bonds, or your 60 stock, 40 bonds, or your 50/50. Unless you're really conservative, you got down to the bottom, meaning you're pulling out a ton of money and you're putting a ton of stress on a portfolio. And if you're really young, maybe they'll put you close to 90, but they're always going to have this kind of, I'll call it a expected return, expected risk, a buy and hold with a teeny bit of rebalance once a year. So then finally, what the advisory firms do, this would go for probably mostly all of them that you sit in front of, is then they choose your investments, which are typically low cost index funds, similar to the ETFs that you see on our live sheet. And then this brings us to something that I want to talk about, which is our what we'll call our benchmark for invest with rules. And for some people, the benchmark might be the S&P 500, but what we want to do is we don't want to lose our shirt in a horrible bear market. So I want to stop here. This is the ticker symbol AOR. You'll see this on our scorecard. You'll see it in our kind of upcoming slides. But AOR is a growth allocation ETF, and these are the actual weights. And I'm not saying to go buy this. I'm just saying this exists, and it's one ETF that has several ETFs underneath of it. It's a really low cost, but you'll see that 34 or 35% is the S&P, 33.5 is international, I'm sorry, is bonds. And then you have IDEV is international at 16. So the bulk of this, like 80+% of this ETF, are these three ETFs. Mike, before we jump into the past 3 years, any comments so far?
Yeah, and just to clarify, I think you said it, but just to double down on it. So people have probably heard of the concept of fund to fund, mutual funds that are a basket of other mutual funds. This is an ETF of ETFs. It's just a basket of primarily other ETFs that create this mix to give you the ultimate AOR ticker. So I just wanted to clarify that just to
Awesome.
make sure
Yeah,
it's
so
understood.
awesome. So this is actually, we're using the software Market Surge with Investors Business Daily. We are subscribers. So we're going to start with the starting point is the end of 2021. So we have all of 2022, 2023, and 2024 is what we're looking at. So far, cumulative returns of IVV, the S&P 500, is up 25, roughly, and a half percent. There's IVV at the way top. Then we have, I want to share with you in our live sheet. So obviously we're in this too. So I sorted it based on IVV and SPY, and these are some of our trades from our trade log. So obviously we take small losses, we go for big winners, and we'll kind of show you how all of our performance stacks up. But just so you know that this is one of the investments that we participate in. Then we'll look at IDEV, since we'll stay on the stocks theme. And again, this was like the third largest position at 16%. IDEV is international developed, which interestingly enough has done really lousy the past 3 years. So then finally, you'll see that's a negative 2.5%. We've actually traded VEU, which is the Vanguard ticker symbol. And obviously, we've had a lot more success than just being collectively down negative 2%. So we've had a couple of good hits. Some of our current positions that are live right now are at really small losses, but we have banked some gains. The opening trades that these are pulled into 2024, as you've seen our log. And then IUSB is the total core bond ETF, which has done just lousy, which is negative 13.77% over this time period. And then finally, you have AOR, which is up 2.3. And we have actually traded bonds this year. So obviously, this has been an environment where bonds went from like really attractive to not. So we used EDV, which is Vanguard's ticker. We used TLT, the longer duration, and we escaped with our 2023 trades with a gain. That's kind of the euphoria time period. And then we had one TLT trade that I found on the trade log that was just a small gain, but obviously negative 13.77%. So, and then finally you have AOR. So the question of all questions is why has this 60/40 stock bond mix underperformed over the past 3 years? There's your answer. So it's the bond allocation and it's the international allocation. And that's kind of sums up where we're at with the 60/40 mix and why it's really struggled. Mike, I'm going to go through our Invest with Rules performance in just a second, but any other things that stick out to you just from kind of this pie chart, 60/40 mix, and then we're going to get into our world.
So, Scott, just a quick question. In your experience, I'm sure back at Fidelity, you also got exposure to people's 401ks, or at least were asked questions about their 401ks. What's the typical, like if anybody watching right now opened up their 401k allocation, what would they probably see?
I'd say the most commonly used investment is a target date fund. And a target date fund is you pick the year in which you're, in theory, going to retire, and it will do the asset allocation drift for you over time. So more aggressive when you're young, more conservative when you're older. So and they typically come in two flavors, actively managed or passively managed using indexes. So that would be my answer to you.
Yeah. And so in essence, it's really boiled down to that chart you showed, the pie charts, basically giving a certain mix of stock exposure and bond exposure based on where the person is in their lifespan, right? Yeah, exactly.
Yeah, and for most of the 401k world, I would simply say that it's not designed for trading. is very simple. An IRA or an individual retirement account is more aligned with commission-free trading. A 401k is not. They will happily slap you on the wrist if you overtrade. But could you use things like, again, mind your risk tolerance, and we'll go through disclosures at the end of the video, but could you use our long-term trend signals? That's a thought, because that would have gotten you out of a lot of harm's way. If you want to go back a couple of videos, we talk about the lost decade and using long-term signals. That's a thought. But I would say that this is really where most people's retirement accounts are, where most advisors would put anyone. And it's kind of a when the market does great, they're always underperforming a little bit. And when the market does lousy, they're losing a little bit less. So they're kind of always somewhere in the middle of the performance curve.
Yeah. And the point of me asking you that question and going down that road was that's why we're kind of honing in on AOR, because that's where I think most folks, typical folks, have the vast majority of their investments in their 401ks when in the working years, right? And they're in a mix like this most likely. Personally, I always was very aggressive in my 401ks. And that's the reason why, for example, I had better performance, but I also had to withstand some major drawdowns because of the aggressiveness, which goes back to what you were saying.
So, Mike, I will put a question back on you. So, why not just buy IVV, buy the S&P?
Ah, therein lies the rub. So for example, me back in my 30s in the prime of my accumulation working years, and the S&P takes a 50% hit. And this is I'm talking reality right now. Say go back to 2008. I think it was eight, right? Or eight or nine, that there was a massive drawdown.
Here's eight.
Uh, yeah, and as a younger person in my accumulation years, buying and holding and dollar cost averaging into a 401k, I was able to withstand that, and I didn't get sick to my stomach seeing that. In fact, I didn't even look at it because most people don't look at their 401ks, right? But when you're now in a situation where like I'm headed towards, like a lot of our clients are, a lot of folks watching this, where now you've got capital that you want to not just keep growing but protecting, that's the problem. Buying, to answer your question, Scott, buying the S&P, buying IVV or SPY, it exposes you those massive types of fluctuations, that volatility, like we experienced in '08, like we experienced, I think was it 15 or 18 during the COVID crash, during 22, etc. So, any thoughts to that, Scott?
No, I would say it's a great strategy until the market runs against you. That's kind of
Oh,
the
one of my favorite quotes that we joke about every once in a while, Mike Tyson. What is it? Everybody's got a plan until you get punched in the face, right?
he's fighting this weekend, I believe. I'm not watching, but he's got to be
Nor
what
am I.
60s taking punches to the head. That's totally nuts.
There you go.
Obviously, why are you underperforming? Not you globally, but why is a 60/40 underperforming? International, it's bonds, it's probably fees, it's probably a whole bunch of things. So let's get into the invest with rules. So we track ourselves against AOR, which we just discussed. We track ourselves against the S&P 500 and TLT, which is a long-term bond. So I'm going to go through our three strategies and then the accumulation strategy. So again, full disclosure, please, this is just past performance. It's not indicative of future performance. You know all those fun disclosures. But I would simply say that the all-weather strategy, which is level one, we call it, and that invests in the large cap indexes. And right now, interestingly enough, small caps are relatively, over the more recent time period, outperforming IVV. So who would have thought small caps are outperforming large caps right now? And we're there. We have an actual relative equal weight to small caps to large caps. So the all-weather strategy in 2022, the hedging was huge. So the hedging gave us this massive lead. And then in 2023, it underperformed the S&P. It outperformed AOR nicely. 2024, it's actually underperforming AOR and the S&P, but because of not having those devastating harsh losses, it is significantly outperformed the stock market, the growth allocation. And then if we move over to level two, the ETF trend finder, which are an ETF strategy, and you'll see things in there booming right now with euphoria like Bitcoin. So in 2022 was flat. In 2023, it struggled. In 2024, it's definitely far greater than AOR. It's underperforming the S&P. It's well more diversified than 11 stocks of the big core of the S&P. And then it's actually right almost neck and neck with the S&P over this, call it almost 3-year time period. It's far greater than the 60/40 mix. And what we're trying to do is deliver outperformance over AOR we're trying to do it with less risk. Before we move to level 3, Mike, any comments?
Yeah, just a quick note that we don't show it here, and we probably won't, but we have dissected recently our performance since our tweaks in Trend Roadmap 2.0 that I think everybody listening probably understands, knows about. And we're close to 3 months into that, let's call it post Trend Roadmap 2.0. And we have not only handily outperformed AOR, that kind of that benchmark, but also have kept up and or slightly outperformed SPY as well. So just wanted to point that out. It's kind of buried in the numbers here because we're showing year to date. But I think members will know if they look at their own portfolio, assuming that they're doing something similar to Invest with Rules model portfolio, they're probably experiencing what I'm talking about.
Yeah, and then on a future video, we're going to talk about like I saw this. I listened to this interesting podcast yesterday that was that investors and us included, we don't like down markets. That's number one. But we really don't like the unknown of what a down market can lead to. Like a 2008, when I remember there was like this moment where the market was down 30 and then a couple of weeks later it was down 50. And having this mental unknown of like how bad will it get, we've actually calculated that including so our stops and then a buffer because we tend to trade at the end of the day because in theory a stop could get broken through. But it was really interesting. So obviously we're picking up some steam here with performance, but moral of the story is like what's our like if everything went horribly wrong, the magic number that we were calculating, and we'll go into this more, was like -8%. So can you sleep knowing that like it's 8%? And if you think about like 2022, the market's lost, as you see on the screens here, 19.5% or 17% or -32%, like eight. That's the pain threshold of everything sliced through stops, and then like we exit at the end of the day of everything. And that's not including hedging. So we'll get into that another topic. So follow the big money. We picked up a lot of steam more recently. This is something that we've been focusing a ton of our time on with Trend Roadmap 2.0 plus the volatility adjusted momentum. But you can kind of see 2022 was down slightly, 2023 challenged, 2024 challenged, but still we're over the 60/40 mix, which makes us kind of our benchmark. We want to surpass the S&P 500, obviously. That's our agenda. And then what if you put all three strategies together? And again, the mix are going to be morphing to more equal weighted, level 1, 2, and 3. But in the past, it was more heavily weighted to level 1. So you can kind of see how the newsletter has performed in regards to competing against the AOR, competing against SPY and the long-term bond market, which has been a really huge pullback in bonds. It's pretty gross. Before we pivot away from performance, Mike, any final words?
Yeah, and this touches on, and you just mentioned it, but I think this also helps to tell a story as to why we're going to more of an equal weight portfolio going into next year. Because of the fact that you never know exactly what part of the or what sector is going to trend nicely versus not. So I think by having equal weighting, by looking at our performance, you kind of see that will help to balance out what's going on in the portfolio next year going forward.
Yeah, and this is all through a Google Sheet, so there's nowhere to hide. We honestly want to do well for ourselves, for our families, we'd love for you to do well. We'd love for everyone to get good results and not get steamrolled at some point when the euphoria gets sucked out of this market, which at some point will happen. So it's like having known risk with an upside that's high. That's kind of the mission at hand, is following those risk management rules for self-directed investors. If you have questions, email us hello@investwithrules.com. We'd love to hear from you. We want to make sure that you're being successful and having good results is really important to us. And then if you're like, I just don't have the time, but this is really interesting. If you're looking for that plus financial advice, email us hello@IWR Advisors. I guess we've made a little updates. We've updated the members area. We've done a lot of work behind the curtain. So at the moment, the newsletter is actually not available to new members. But if you do have any friends or family that you're like, this could be something that they may enjoy, we do have a wait list, and the goal is to open up later. At the end of the month, we want to thank you. Mike, any final words?
Thank you and happy trading.
Talk soon. I hope this helped you kind of identify some either uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com. Thanks so much.